Hello, everyone. My name is Andrew Payne, and I'm a junior in the AIM program covering domestic industrials. Today, I will be pitching Owens Corning, ticker OC, at a price target of $123.84, representing upside of 45.43%. Owens Corning is a manufacturer and provider of building and industrial materials. They operate through three main segments: roofing, making up 37.8% of revenue, insulation, making up 37.5%, and composites, making up 27.5%. They target three main end markets, including residential, commercial, and industrial. Owens Corning operates in the United States, which makes up 67% of revenue, Europe making up 16.3%, Asia Pacific making up 8.8%, and the rest of the world making up 7.9%. The company was founded in 1938 and is headquartered in Toledo, Ohio. Over the past 15 years, Owens Corning has successfully repositioned its three revenue segments to focus on one key factor: sustainability. As of 2021, 61% of the firm's revenue were derived from products that save energy or reduce emissions. Along with sustainability, Owens Corning also focuses on its capital allocation strategy of returning over 50% of free cash flows back to its shareholders each year through share repurchases, plans, and dividends. For instance, Owens Corning has 13.4 million shares available for repurchase. In 2021, the revenues increased 20% year over year, and operating margins grew by over 650 basis points compared to full year 2020. They were able to generate these revenues by staying in front of inflation and delivering a positive price-cost mix. These factors led to a healthy balance sheet and free cash flow conversion of 115% for 2021. Owens Corning plans to expand its addressable market from $40 million to $200 billion by strengthening its position in core building and construction products, expanding multi-material systems, and developing prefabricated solutions. Due to Owens Corning's proven financial performance and room for strong growth in the future, it is recommended that it be added to the AIM Small Cap Fund with a price target of $123.84, representing 45.43% upside. The first driver is secular trends. Owens Corning is well positioned to capitalize on secular trends occurring within their targeted end markets. There's really four trends that will drive revenue growth and free cash flows in the future. These include increased premium on living spaces, changing construction practices, demand for sustainable solutions, and the investment in infrastructure. The premiums put on living spaces are expected to drive investments for new residential housing and renovations. As we continue to see and feel the effects of labor shortages that impact construction practices and construction cycles, it will create the need for multi-material and prefabricated solutions that can drive efficiencies. The demand for sustainable solutions continues to accelerate as the global need to reduce greenhouse gas emissions, improve energy efficiencies, and develop more renewable energy sources increases. Lastly, we'll continue to see the need for investments to upgrade and expand infrastructure, namely through the infrastructure bill. The second driver is the future of insulation. Just over the past 5 years, insulation segment has grown at a 10% CAGR. And this trend will continue or even expand as more states begin to adopt the 2021 IECC agreements. As of 2021, 90% of buildings in the US and 75% in the European Union are insulated. The European Union estimates that 35 million homes and buildings in the US will need to be renovated by 2030. This will require an additional $290 million of insulation each year. Owens Corning has an industry-leading margin structure, besting the industry average by 350 basis points. This structure will allow Owens Corning to be flexible in its pricing structure as they face rising inflation and interest rates. While the insulation segment benefited from a positive pricing cost mix and increase in volume in 2021, the growth in the future will also be driven by the residential and commercial switch to sustainable and energy-saving solutions. As energy prices continue to increase and states begin to adopt the IECC, Owens Corning will benefit from the possible increase in volume and positive pricing structure. The third driver is the investment in composites. As of 2021, Owens Corning Composite Segment makes up 27.5% of revenue, and it's expected to make up 33% of revenue by full year 2024. They plan to meet these revenue expectations by strengthening the company's position in core building projects and pivoting the composites business into higher value building products and materials. Owens Corning has already begun transitioning to higher value building products and materials as they increase the number of product launches in the composite segment by 30% in full year 2021. Product rollouts and innovation is expected to continue as management has forecasted a 20% increase in research and development spending in 2022. This R&D spending will go towards multi-material and prefabricated building solutions, which are needed as applications within the construction industry continue to evolve. Besides growth and innovation aspects, the composite segment offers diversity to the other revenue segments and balances out the cyclicality of roofing and insulation segment. So to reach an intrinsic value of $110.40 for Owens Corning, a 5-year DCF model is constructed. To reach this intrinsic value, a terminal growth rate of 1.5% and a WACC of 9.31 was used. A sensitivity analysis of the terminal growth rate in the WACC of 50 basis points from $123.89 to $104.31 was conducted. A relative EV to EBITDA and PE valuation was also used, with multiples of 11.07 and 16.39, resulting in a relative valuation of $163.64 and $164.65 respectively. By weighing these models, 75, 12.5, and 12.5, a price target of $123.84 was reached, which represents upside of 45.43%. The firm also pays a dividend yield of 1.5%. So there's 3 risks associated with Owens Corning, the first being low levels of construction activity. The roofing and insulation segments have historically been very cyclical, and if there's a downturn in the economic cycle, this may have an adverse effect on Owens Corning's revenue segments. The lack of long-term volume agreement is also a risk, as Owens Corning's strategy involves avoiding long-term contracts to maintain their positive price-cost mix. Lower demand for products would have a negative effect on margins and top-line revenue growth. Finally, failure to innovate products and materials is the third risk. Innovation of products and materials, especially within composites, allows Owens Corning to maintain their pricing structure and competitive advantage. Failure to innovate products may potentially cause a decline in growth, especially within their composite segment. Brian Chambers has served as president and CEO of Owens Corning for the past 22 years and as chairman since 2019. Mr. Chambers received his MBA from Northwestern University. Kenneth Parks has also been with the company as CFO since 2020. Before joining Owens Corning, Mr. Parks held CFO positions at both Mylan and Wesco. The average tenure for management is 10 years. Thank you all for watching this presentation, and I look forward to answering any questions you may have this Friday, April 8th.